A $500,000 house sounds expensive. But that's not the real number. The real number is closer to 1 million, and almost nobody realizes it until it's too late. Because most people don't buy a house based on the full cost. They buy it based on one number, the monthly payment. And that number is designed to feel safe. But it's not the truth. And when you run the real math, it gets brutal fast. Let's start with something simple, the down payment. On a $500,000 house, a standard 20% down payment is $100,000. Not financed, not borrowed, not, I'll figure it out later. Cash. Right now. The median American household has around $8,000 in savings. So before we even talk about mortgages, most people are already $92,000 short. And that gap doesn't close quickly. Even if you earn $80,000 a year and save 10%, which is already above average, it would take you over 12 years to reach $100,000. Assuming prices don't rise, they will. So let's say you compromise. You put down 10%. That's $50,000. Now you're financing $450,000. At around 7% interest, your monthly payment looks like this, about $3,000. And this is where most people stop thinking. Because $3,000 feels manageable, but it's not the full number, not even close. Now we add everything else. Property taxes, about 1.1% annually. That's $458 per month. Insurance, let's say $250. Private mortgage insurance, because you didn't put 20% down. Another $300. And then the one cost everyone ignores, maintenance. About 1% per year. That's $417 per month. Now add it all up. $3,000 times $458 times $250 times $300 times $417. Your real monthly cost is $4,420, not $3,000, $4,420, and that's assuming nothing goes wrong. Now here's where the math gets uncomfortable. How much do you need to earn to afford that? Financial planners say no more than 28% of your income should go to housing. So if $4,420 is 28%, you need to make about $189,000 per year. Even if you stretch it, at 36%, you still need $147,000. And at the absolute limit banks allow, you need over $120,000 just to qualify. Now think about that. Only about 13% of households make over $150,000, which means the majority of people cannot comfortably afford this house. Not because they're irresponsible, because the math doesn't work. But people are still buying them. So what's happening? Some are dual-income households stretching both salaries, some have family support, and some are just hoping it works out. Let's make this real. Take a household earning $155,000. After taxes, they bring home about $9,200 per month. Now subtract housing, $4,420. They have $4,780 left. Now life happens. Car payments, $900. Insurance, $280. Gas, $300. Student loans, $700. Health insurance, $380. Groceries, $850. Utilities, $420. That's $3,830. They're left with $950. That's not freedom, that's pressure. $950 means every decision matters. A car repair isn't annoying, it's stressful. A medical bill isn't inconvenient, it's a problem. And one bad month can set you back for the next 6. And here's the part nobody tells you. The system isn't built to protect you. It's built to close the deal. Banks approve based on risk, not comfort. Agents earn when you buy, not when you thrive. And prices? They follow the market, not your income. So what's the right move? Start with your real income, your take-home, not your gross. Take 30% of that. That's your true housing budget, everything included. Then work backward. Whatever price fits that number, that's what you can actually afford. Not what the bank approves, not what the market suggests, what the math supports. And sometimes the answer isn't no, it's not yet. Because there's no prize for being house poor, No reward for owning something that controls you. A house should give you stability, not take it away. Run the real number, not the payment, the number, and then decide with your eyes open. Most people will never run this math. Now you have. If you want more breakdowns like this, simple, honest, and actually useful, follow Mind Over Money, because the right information changes everything.